Yeah, hi, good afternoon. Today we're here with Peter Bruce Clark from the Social Impact Capital, an impact investor venture capital fund based in the US, but like with, as far as I know, global activities. That's also how Peter and I met at one of the conferences here in Monaco, where Peter had been speaking about impact investing, and I thought that was very fascinating. And that brought us actually to today's conversation. So, Peter, thank you for being here with us today.
Thanks for having me. Good to see you again, Alex.
Thank you. Can you tell us a little bit about yourself, your background, and how you entered the space of venture capital, but particularly from the angle of impact investing, which I find very exciting?
Yeah, absolutely. So a little bit of background about myself. So I grew up between the UK and Australia. That's my sort of like genesis, as it were. And I grew up in a household where we really talked about why we do things and what long-term value is, and basically doing things in alignment with your incentives, but also your values. So, what does sustainability mean? What does really investing for the long term mean? Those are the things that we sort of like grappled with, which is probably slightly unusual to be in that environment growing up. But it always, I think, was kind of like my North Star, I think, in terms of just my decision making and even my experiences or choices with what I did in my early career. I started my career in London working for Oxford Economics as well as Oxford Analytica, which are basically macro research advisory firms for large corporates and investors and that kind of thing. And that's really where I got the, I guess, itch and bug for deep research, deep industry research, as well as like sort of consulting elements. I found it always very interesting in general, flows of capital and how flows of capital determine people's realities in many respects, both objective and subjective realities. And then I also have a bit of a quirky background where I did a lot of psychology, philosophy, and literature. And for that, those sorts of experiences really taught me about the way in which we perceive the world is so much a kind of generative effect of our underlying circumstances. And so, in a really long story short, all of these sort of intellectual experiences and work experiences, also working for large investors when I was at Mercer and seeing different flows of capital going in different directions, I was like, one day, why is capital flowing in that direction? Like, I just don't understand. Can't we sort of flow it not towards like these big oil companies? We could probably allocate this capital better in more productive ways. And I'd also like learned about impact investing very early on when I was still at university, when I went to Cambridge for my master's. That was sort of a hot topic at the time. And it was actually very funny. I learned about that underneath a guy called Lord Eatwell, which I always found hilarious as a name, but was very, very fascinating, fascinating course. So anyway, one day I got this opportunity. I think I'd bounced around a lot of different firms in London. At that time, the startup ecosystem in the UK wasn't very robust. Neither was the venture capital ecosystem. For instance, I met James Wise at Boulderton before Boulderton really became what it is today. And back then I thought, oh gosh, technology and venture capital, what is that, right? And I was probably like, young, wide-eyed and excitable really about the future. So anyway, after my master's, I went back to London. I did research about sovereign wealth funds, and sovereign wealth funds are super interesting because they're, about double or triple bottom line investing. It's not just about generating money; it's also about generating economic diversification or new areas or new industries within a particular economy. And so I found that very interesting. And then one day I got a call from Ashby Monk, who is a world-leading sort of funds management expert who's at Stanford, but also a kind of jack of all trades guy, very Silicon Valley, had several startups, also an investor. And he's always interested and has always been interested in the kind of engineering of finance and incentives behind finance, and what enables investors to do things, and what kind of prohibits people from doing things. And a lot of that comes down to technology. So anyway, he one day sort of suggested, hey, I know you really want to do impact investing. I know that's an area that really fascinates you. I'm actually working with a couple of family offices discussing a impact project. Would you be interested, or maybe, you know, open to kind of a discussion about whether or not you want to be part of something like that? And so I basically moved to Silicon Valley. I knew no one there. I knew nothing about venture capital. I knew nothing about technology. And I ended up working with the Donnelley family out of Chicago. So the R.R. Donnelley is the company, and Elliot Donnelley there, who's wonderful, as well as some family offices in Los Angeles and Stanford, to try and come up with the best model for delivering impact. The idea was, can you create the contours of an investment vehicle that could deliver you know, sort of double or triple bottom line returns, but also alpha. So it wasn't just even about a concessionary approach or anything like that. It was like, can you deliver both high impact and high returns through an investment vehicle? So I basically got to deep dive the entire Bay Area, as well as I got to travel globally for this too, and meet with lots of different investors all around the world doing impact. So I met with like Ronald Cohen and some of like Bridges and all of the sort of legacy of impact, at least in Europe and in North America at that time. You know, DBL, double bottom line investors, was probably on their, you know, second fund, if that. So it was still very nascent. And in fact, I was doing the math today about the size of the impact market. It's still very nascent in many respects, in terms of impact assets in private equity. Really, really few and far between. So anyway, so flash forward, I did a very typical Silicon Valley adventure. You know, I tried to launch a machine learning focused venture capital fund focused on high impact areas of application just before the AI hype cycle. That was really interesting. I ended up meeting lots of different kinds of investors, also working with some colleagues who were also seasoned investors and entrepreneurs. And there I kind of thought, wow, like machine learning could really augment our decision-making capabilities and our ability to automate processes like, for instance, like the GP process, right? And going to your GP to decide whether or not you've got something, or maybe you might have something, versus having a machine that looks at your biomarkers and says, you've got type 2 diabetes. So I found that very interesting. That did not come to fruition, but it was very, very interesting as an experience. And then from there, I joined a investment technology startup called Real Capital Innovation. It was just actually acquired by Adapar, which is a quite large wealth management firm, but particularly tech-enabled wealth management firm in the Bay Area, seeded by Joe Lonsdale and ABC. And there I was head of business development. And again, it was going back to this idea earlier on in my life as, you know, long-term investment. What does that mean? How do we do it? Can we do it through technology? And could we manage these multi-billion-dollar funds, like large pension funds or sovereigns, in more discreet and more effective ways? So that was very, very interesting as an experience. I got to talk to a number of other sorts of different kinds of investors and look at their sort of agendas and what they're trying to do. It was never really what I really wanted to do. You know, it was not my calling. It wasn't exactly why I was in Silicon Valley. You know, as I said, I've always been very passionate about impact investing. During all of this is about around the same time I met Sarah Cohn, who's the founder and managing partner of Social Impact Capital. And there it was really just amazing when I first met her, because in all the research that I did at Stanford and with these family offices, I realized that we couldn't really agree on what impact was. And because we couldn't agree on some fundamentals, and what I mean by that is presuppositions and assumptions around what impact actually is, my sort of pushback was, well, how can we design an investment vehicle if we can't agree on that, right?
Do it. And how did you define impact? Yeah. Sorry to interrupt you here, but
no.
Super important.
Yeah, well, in fact, I sort of actually defined it to begin with what it was not, and by sort of deselection of what impact was not, I basically came up with the contours, which is basically filling capital where there are gaps in the market for capital with projects that would otherwise be overlooked by the market. So it's very much like an ex nihilo approach to investment management, meaning designing something out of nothing, businesses or sort of projects that otherwise wouldn't exist. And then it's also the additionality of bringing to market, I think, those projects and those businesses into the mainstream. I think that's really what the operational model of anyone deploying an impact strategy in any asset class is doing. It's bringing to market something that otherwise wouldn't exist. And so, some people like Peter Thiel talk about it in terms of economy 3.0. That's kind of the phase that we're in right now. So it's like sort of that, and then anything that had social or environmental impact built into the actual business model. So intrinsic to whatever the business is producing as a good or service. That was another kind of heuristic. Whereas, ESG investments, that's more, it's more retroactive. It's more of a public market strategy. It's less about making businesses do entirely different things as it is a matter of being less bad, right? Or doing things more efficiently or more effectively through sustainable practices.
Okay, so now coming then to the point that now you're having your fund, right? How do you run your day-to-day funds operations, and how do you source actually those startups? And do you manage to please your LPs, which is also very important because they are investing in you because they want to do or have a social impact, I believe. But at the same time, they are still investors and not like just giving donations. So how is that working out?
Yeah, no, it's great. So we are a top decile performing fund in the venture capital asset class in the US. So we are our first fund, Fund Zero, is in the 98th percentile. Our more recent fund is in the 99th percentile. So we're a top decile fund. We look for businesses where not only do they present themselves as kind of profound social environmental impact, but also look like they could be venture backable and have a sort of exit which could be $1 billion or upward, right? So we're very classic in a sense that we are a typical venture capital firm. It's just that our investment lens is specifically selecting for impact deals. And our sort of 3 different modes and the 3 different things we do at our firm. So we invest in the best ideas in impact. So basically sector agnostic, geography agnostic, and to some degrees cause agnostic. We do impact arbitrage, which is effectively bringing to market overlooked opportunities at seed, and at Series A getting sort of the top funds in the Bay Area, but also across America and internationally to lead our A rounds, which is really valuable for our portfolio companies and our entrepreneurs, and sort of like sets them on their way for subsequent rounds of financing. And then we're also innovating the venture capital model such that we are benefiting from the advantages of generality with the advantages of niche fund strategies. So what we've got is a kind of hub and spoke model with expertise where we pay people for the material value that they bring to the firm. So we get to work with now over 55 different venture partners and advisors, all who are enumerated on a deal-by-deal basis based on kind of the material value they bring to the firm.
Can you explain a little bit more in detail how the venture partners are working with you?
Yeah. Yeah, sure. So it is really flexible as it is a sort of philosophy of you get out what you put in. So there's a kind of sliding scale function. I won't talk about our secret sauce in too much in terms of incentives, but it spans anywhere from deal sourcing all the way up to taking a board seat on our behalf, and particularly helping us with deals that are particularly complex, say in deep tech or biotechnology, where having specialist domain expertise is very, very valuable. Our belief system is basically that you can't have the world's second best expert. And just because you've got a PhD in machine learning doesn't necessarily make you a good venture capitalist. So the idea is that you plug and play expertise where it makes sense and where entrepreneurs would like it. And our sort of view is we want to create this net that covers the world where we have both regional and sectoral and technological domain expertise that depending on where you are on the life cycle of your business or the things that you're grappling with at the early stages, we can just airdrop in that expertise. And it's worked really, really well in practice. So for instance, with a lot of our biotech deals, Jason Ponton, who's at Flagship Pioneering, sits on the board for a lot of those deals. He has been a wonderful resource. He actually just led and oversaw our last round of financing in Totus, which was just actually follow-on financed by DCDC Bio. So having somebody like Jason, who has had decades of experience in biotech and healthcare, really, really valuable to have on the board. Not just for his own expertise, but his own networks and his own relationships, right? And that's what's so fascinating about this. So that's kind of the ethos behind it.
And on the portfolio firm side, so the companies you have been investing in, can you tell us like a couple of like cool stories, why you have invested in them, and what they are doing to be that special? And a third question related to it, how did you find them? Okay, like some might come through venture partners, but are you active on social media or you just have a network? Like how do startups find you or do you find them?
Yeah, so the sourcing question is super funny because people would assume that through our venture partners and advisors, or indeed we have LPs that are some of the best venture capitalists in the world, many of whom now are managing really, really large funds. So it doesn't make sense economically to be dabbling around in the seed stage, which is where we typically first invest. So we do get sort of deals from our venture partners and advisors. We also get deals from our follow-on financiers, deals that are too early for them. But then also, intriguingly, we get really good cold inbound. So some of our deals, and I'd say it's the breakdown is probably sort of 20, 20, 20, 20, like this whole sort of quite evenly broken down sourcing. So a lot of it is passive, I would say, versus us actively going out and trying to hunt for the deal. And we've designed the firm and our brand to be a natural lighthouse for high quality impact deal flow. So even just yesterday, I found this amazing energy data company, which I've been looking in the space for quite a while with sort of grid efficiency. And that came through our hello@impactcat.com. So that came cold. Also, one of our deals that just recently received financing from True Ventures, it's called Tiamat Sciences. It is essentially a kind of platform for designing plant growth factors, so alternatives to sort of cellular ag, kind of the current mode of doing that, which is typically pig embryos. So it's not truly vegan. That's the kind of the naughty little secret of lab grown meat, is that it's really not vegan. Whereas I think that Tiamat can enable that, but not just enable that and make it vegan, but also make it really, really cheap to produce lab-grown meat. And that's actually something that Sarah and I have been looking for quite a while, as something that could actually make the field economic. And that's why we hadn't done anything in this space before. But anyway, we found Tiamat in our inbox, right, based in Belgium, and we brought them to North Carolina. Interestingly, now we've also looped in Ryan Bethencourt, who helped set up Indie Bio from scratch and was also one of the original investors in Possible Burger, to sit on the board on our behalf. So, it's really, really different kinds of channels. We will look at anything coming in any direction. We've got deals off of Twitter. I've got deals off of Instagram. Like, you name it, we are open to chatting to you.
What do you think, now, not directly related to your VC fund, but speaking of like the Bitcoin hype lately, because there are certain things about it which are obviously not necessarily sustainable, which is the electricity consumption. So what do you think about like blockchain, electricity consumption, Bitcoin? And is there a way to also leave their legacy and an impact to make even that future technology a bit more efficient?
Yeah, I mean, in principle, cryptocurrency is and sort of blockchain-enabled solutions are fascinating in this decentralized mode of giving power back to the average person, and giving agency to the average person. I think that is really compelling, and for it to be also a hedge against a global economy that is effectively postmodern right now. It's pretty detached from underlying reality. So I could understand it from a hedge perspective too. I think for us, we're less interested in cryptocurrencies as we are blockchain solutions. So for us, more recently, we did a deal which is in the sustainability space called Topple. Topple, Kim Rath is the founder there, and essentially it's credentializing ESG claims on the blockchain. So anywhere from harvesting cocoa to selling it to somebody, at the store, you can automate and credentialize whether or not the ESG practice is actually happening at each node of the process. So we were really excited about that because it's all very well approximating claims with statistics, right? Like even with carbon accounting and reporting, right? Even if you go to scope 3, it's still statistical and it's still kind of generative on the data that you've got. So how do you get closer to the object of the ESG practice, if that makes sense? The consumption of of energy in actually a lot of different projects is super interesting. Like blockchain aside, when you think even about electric vehicles, I always remember I was at this conference in Marrakesh a couple of years ago, and I was at this after event for the conference, and I got approached by one of the heads of the World Trade Organization. And the guy there was like, "Oh, you're a strapping lad from Silicon Valley. Like, should I buy a Tesla?" And I was like, "I don't know. Do you care about the environment?" He's like, "Yeah, I really care about the environment." I was like, "Okay, cool. Then you should buy like a secondhand Ferrari." If you think about the entire supply chain of building a new car from scratch, and also the environmental footprint of creating batteries, right? It's actually pretty bad to buy a new car. You may as well buy a Ferrari. But then I asked him, "Do you care about the future?" Right? And he said, yeah, I really care about the future. I was like, "Great, you should buy a Tesla." And so my problem is not so much that these new innovations have an environmental footprint now. What I really care about is how do we respond, not react, but respond to information that shows us that the way in which we're doing things is not sustainable, right? Or creating a negative externality. So I've been on another podcast talking about this. I'm less concerned about job automation and climate change. I'm more worried about people's attention span and latency.
Yeah, I kind of get that. But I honestly love like that example, looking at the second-hand Ferrari and on the other hand, the Tesla as a future vehicle. Speaking about the future, actually, where do you see the future of VC going? Where's the future of startups going? There's also the future of, let's say, investments in general going. What are your thoughts on that?
Everything's leaning towards sustainability, accountability, and a sort of transformation, in my opinion, of capitalism, where we, for a variety of different reasons, have now looked to the market as the solution, particularly in the United States, right, where we don't have as a robust of a social support or social safety net versus, say, Scandinavia, the Nordics, or some other European countries, or indeed some Southeast Asian countries that look after their citizens by government, centralized government, right? In the US, it's very different. In lots of countries that over the last 20, 30 years look to the US as the great model of how you do business or how you build societies, the sort of like liberalization of markets and that kind of thing. I think what that does is put the pressure on corporations and investors to pick up the gauntlet of social responsibility, because and then bake that into your own way of doing things. And that's the only way in which you can actually look after others, if you've sort of subscribed to that model of how we generate flourishing societies. So I think the future of investment management is trending towards ESG, just on the public side in general. There's a lot of data now that shows that ESG products financially outperform relative to traditional benchmarks. There are a variety of reasons why that happens. It's also to do with sort of cost efficiencies, and sustainability and another way could be seen as kind of an approach to investment management that really looks at your supply chain and figures out where the excesses are. Versus on the private side with what we do, or even in real estate, private real estate and infrastructure projects, in private equity, where I think that we are now building in a very Thielian way economy 3.0. And that basically exists because if you look to prices to consumers and businesses for what you could categorize as core needs or essential needs, goods and services, over the last 50 years, those prices have astronomically risen. So in healthcare, in education, in transportation and energy, that's what you've seen as a trend. Whereas superfluous to needs, goods and services, fashion, toys, electronics, they've all decreased in price. So there's just pure economic reasons why you would want to be investing in this space. I think that sometimes people, listen to an impact idea, or they think about impact in general through in investment, and they think, oh wow, it must be concessionary. Like no, they're just like very clear market-based reasons why this sort of thesis is one that looks at businesses that are disrupting areas that are ripe for disruption, basically.
Actually, that reminded me of something. I don't know if you know, but I did my PhD at some point about employee stock ownership and the cost of capital. Mm-hmm. Now, is that an aspect you are looking in when you are investing in startups? How the shareholders, or like how the founders are giving shares to some employees? And is that a model of distributing wealth throughout society? And does that matter to you?
Yeah, the stakeholder and stakeholder capitalism is a super interesting field. It's fascinating. I once went to this seminar with the senior advisor to the Prime Minister of Japan, and he was sort of talking about how balance sheets have changed since the 80s to regard employees not as assets, but as liabilities over time. And also how we've trended towards moving away from tangible assets to intangible assets, and seeing how that really is skewed in a certain way. And all of their platform, and actually the Japanese platform, is rediscovering the stakeholder, or understanding that we exist in an interconnected shareholder universe, right? For us, I think that, of course, it's really important to think about the shares and the ownership that you leave aside for your employees, particularly as incentives. The interesting thing is when you're a mission-driven entrepreneur in general, you're thinking more about your footprint, let alone just like your carbon footprint, just your general business footprint in the world. And what you naturally see with those kinds of entrepreneurs is they're way more forward-thinking in that regard. In terms of how you manage businesses over time, and I think this is where it becomes slightly more interesting, something that I have been grappling with probably over the last 6 months, is not just, okay, let's invest in businesses that are highly impactful, whatever they're producing as a good or service, right? I think that's a baseline. I think it should be a baseline within venture capital in general, because it's the only asset class that really is in the business of reality creation. So why don't we just build better realities through venture capital? That's kind of my belief system. And then, on top of the evolution of venture capital and managers like us that are impact-driven venture capital firms, yes, we've got accounting and reporting, but what about portfolio management, right? In terms of how these businesses evolve over time. It's all very well investing in an impactful company, but how do you know that it evolves in a way that sort of has fidelity to the original modus operandi of the business, right? Like, how do you ensure that that impact and the potential of that company is enduring? And a lot of that comes to sort of cultural practices and policies internal to companies, as it is ownership, as it is also people that you've got on the cap table and other people that you're co-investing with down the line.
Thank you for your analysis on that side. As I promised you, we'll try to keep it in a time frame of 20 to 30 minutes, as we are soon hitting the 30 minutes. Maybe last very open question. Is there anything what you particularly would like to share with our audience when investing in venture capital, or when investing in social impact what to look at and how to do it, yeah, from your point of view?
I mean, in general, if you want alpha in venture capital, let's just put impact aside for a second. You see that most of the performance and people creating significant multiples on capital are not managing more than 250 million. They're not going that later stage. So I sometimes joke that I don't really understand the point of Series B and beyond venture capital, because I just don't think you're doing venture capital anymore. You're not actually taking risk, in my opinion, because you've already figured out like product market fit, you've already got traction, you're already generating revenue. It's just like a growth phase. And frankly, there are loads of private equity firms who are very technically skilled in figuring out how to engineer businesses for high growth outcomes. It's not just about pumping money behind something. That doesn't necessarily result in, as we may have seen more recently, profitability. So, you know, for me, I think if you're really wanting to do true venture capital is early stage. That's where you can generate significant multiple returns on capital deployed. You know, early stage between C to Series B, that's really where you can have the most bang for your buck. And over 250 million, performance starts being negatively correlated with AUM. So the more you grow, the less likely it is that you're able to generate these significant multiple returns on capital deployed. So if you're looking to deploy in venture and you're excited about this space, my suggestion would be go early, go with new managers that are actually deploying novel investment strategies. Don't go for the herds. That's not how you generate performance in venture. Go for the people who are different, who maybe don't even look like you, because they're doing things that are different and actually kind of cutting edge. And it's interesting, I know the CIO of a very famous British university endowment who was like in the original Andreessen and the original Sequoia, right? And those were the best vintage year funds. So funds 1 and 2, and they start to tail off around fund 3. So you really want to be in the emerging manager category, I think. In the impact space, what I would look for and be very circumspect around is greenwashing. It is now rife. Not even in venture, just across the board right now. Everyone is pivoted towards ESG. And so, you know, I've been like shocked about the product there on the market. So really paying attention to the fundamentals and what the commitments are and what the legal commitments are from the portfolio managers or the managers that you're working on. Super, super important. And it's interesting, even looking at some of our peers, and I don't like throwing people under the bus, but I look at other managers and their annual reports and I'm like, wow, this is glossy and beautiful, but it's completely hollow. So really, really paying attention to what the commitments are on the legal side with the managers that you're investing with.
Thank you so much, Peter. I think that's a very nice rounding up of our today's talk. Peter, thank you again for being here, sharing your thoughts with us. I hope we will have some more future talks. And of course, I'm excited to have you also being part of my next book coming up. So thank you for that. And to everybody, thank you for joining today's episode. And if you like it, don't forget to like the like here. And I hope to all see you soon again. Bye-bye.